Post a link in the chat. For those of you joining us early, what's going on? Welcome to our Day 4 Trading Strategies video. We're going to be going over a bunch of stuff in today's class. Who's going to be the first one in the stream? Let's see. Alright, posted all the links. Now we're just gonna go ahead and wait. Playlits, the first one. What's going on, Playlits? The real Popeye, Kev Cave, good to see you again. Let's all get votes. Master 42, what's going on? We're just going to go ahead and let everyone get into the chat while I pull up the homework from last night. What's going on, Michael Dots? Durham Dad, what's going on? ND Music. ND the Great, even better. That's a good name. Who else is in the live stream so far? Pop in your Discord names. Let's see what you got. Let's see who's here. Is Pookie in the house? Pookie's Revenge. There he is. What's up, Pookie? What's going on? Steven Ibanez. Unsung Hero. What's going on? All right, we got 30 people in. We'll go ahead and start the stream. Let me go ahead and record that. We're good to go. Brisbane, what's going on? I got a whole page full of notes from today. Made it way more manageable. That's what's up. Yeah, notes are definitely the way to go. Ghost the Reaper, what's going on? Corey, first time. Welcome, Corey. What's going on, penny boys and gals? It's your boy, What the Duck here, and as always, it's time for another trading class video. Got some of our regulars in the house. We got Playlits, we got Kev Cave, we got Matster42, we got Ghost the Reaper, we got Pookie's Revenge as always, and we got one of our first timers, Corey Bishop. What's going on, Corey Bishop? We also got Durham Dad and a whole bunch of other great members, so thank you for joining us. Today we are doing a trading strategies course. This is our day 4, which means it's our final course for trading strategies for the week. So what we're going to be doing is we're going to be going over different types of game plans that you can do. So we already went over trading psychology last week, and then yesterday we went over buy-in methods. The day before that we taught you how to buy and sell different stocks in Webull or in, or actually we basically mostly do the Webull app. So, and you can kind of correlate that to Robinhood as well. It's very similar as far as the limit orders and the stop losses and all that goes. So you know how to buy a stock, you know the psychology behind buying stocks, and you also know a good buy-in method from our 25-25-50 class. So now we're going to put it all together and create a game plan. So as always, we're going to be first going over our homework. And this is all so that you can end up being as profitable as this person right here and so many of our other great premium members who are making some amazing profits off of our premium alerts. So let's go over the homework. So the first question, and this was a yes-no question, the question is, does 25-25-50 mean that you have to buy 25%, 25%, 50%? And what this means is 25% of your intended position and then 25% and then 50%, which means that you're not buying in all at once. The correct answer, which 100% of the class got, is no. It does not mean that you have to buy 25, 25, 50. It's just a buy-in method. It just means that we're buying in slow. You can do 10, 10, 20, 20, 40. You can do 10, you can do 20, then 20, and then 30, and then 20. You can do whatever you like. The main point is that you're buying in slow, you're not going in all at once, and you're making that final buy upon confirmation of uptrend. And the reason that we do that is so we get the best average possible. Next question, if you're not in 100%, for example, you're only in 50% of your intended position, and the stock starts to run way past the ideal entry or average, should you still make your last buy? Well, 84% of the class answered no. And they were correct. If it's already above the entry and your last buy would average you up to an average that you don't want to get, just let the stock run. You're in 50%, you're still making profit. Profit is better than losing. And the way that we do it is by getting a good average, and by buying it slow, we are getting rid of some of the risk. So yeah, sometimes you might only be in 50% or 25%, but you're still getting profit. The other downside would have been if you went in 100%, you could have stopped out really quickly, or you could have lost money, or you could have been a bag holder if you weren't following a plan. So it's better to buy in slow and have the risk of winning, going up when you're only in 50% than risking losing when you're in 100%. Is 25-25-50 an averaging down method? 73% of the answer of the question, 73% of the class answered no, and 26% answered yes. The correct answer is what the 73% said, and that is no. 25-25-50 is not an averaging down method. What's going on, Lauren? What's going on, Salvador Girl? Welcome to the class. It is not an averaging down method. Averaging down only happens when you're in 100% of your position. So averaging down is what people do when let's say you want to put $100 into the stock, you're already in $100, and now it's going down, you're like, oh crap, now I'm holding a bag. I'm going to average down. Averaging down is a negative thing. What we're doing is not a negative thing. What we're doing is a positive thing, because we are getting the best position possible and getting the best average possible so we can get the best profits possible. Because the lower your average, well, the better profits you can get. And yeah, Stephen Ibanez said it happened to him today. He was only at 50% on JOB and missed out when it took off. Well, you could have been in 100%, and guess what? It could have gone down, and you could have ended up losing. So it's better to risk that than risking losing. And you still made profit, which is always a good thing. So the next question is, should you set a stop loss after your initial buy-in? For example, your first 25% buy. Well, 26% answered yes, and 73% answered no. And typically we do not recommend setting the stop loss until you're in 100%, because until you're in 100%, you're just still getting your average. You're still building your position. There's no reason to set that stop loss yet because you're not in yet. So the next question, in an ideal situation, your final buy would be at, and 15% said the bottom, which would be like the bottom of the stock. So the stock went all the way down to $1 and then came back up. That's the bottom, is $1. Or when you start seeing strong upward confirmation, and the correct answer is what 84% answered is, in an ideal situation, your final buy would be at when you see strong upward confirmation. No one can guess the bottom. We're not trying to guess the bottom. That's impossible. We don't have crystal balls. We can't tell the future. We're not going to try to do something that's impossible. What we can do is that we can see strong confirmation of uptrend, and that's when we put in our final buy. What do you do to determine your last buy? So I put in as some of the answers: moving averages, news, volume, past resistances. Well, although those are all correct answers, the real correct answer is all of the above, which everybody got. So good job on that one, class. Because you do want to use more than just one thing to find upward confirmation. Just because the moving average is showing that it might be upward confirmation, but there's no volume, well, it might not be upward confirmation. Then you want to use a bunch of different things and combine it. Should you try to make all of your buys on the same day? And this is for swing plays. And 100% answered no. You're not trying to do it all at once. You're not trying to go all in one day. This is a stock that might take a week or two. This is a swing trade. So you don't want to just go all in one day. It's the same thing as going all in one buy. Just like going all in one sector, it might be the same thing as going all in one stock. Is it okay to make your final buy to average up? And 84% answered yes, and 84% were correct. It's okay if you have an average of 72 cents and you see that strong upward confirmation, and it's like, let's say, at 75 cents, it's okay to average up as long as it's still under the ideal average, as long as you can still get good profit off of it, then there's no problem averaging up. You want to go all in? That's great. Go 100% in on the upward confirmation, even if it means your average goes up a little bit. But you want to still make sure that you're not averaging up too hard, because then you won't get as good enough profit. So if you can still get some good profit out of it, based off of your plan, which is your risk to reward ratio. So let's say you're looking for 10% profit, and the target is still at that 10% profit even after you average up, then you're fine. If it's not, though, if you averaging up would only give you a 2% profit at your target, then maybe you don't want to do it. You just want to let the stock run when you're in 50%. All right, what's a better buy-in method? 25, 25, 50, 10, 10, 10, 15, 15, 40, 5, 10, 15, 20, 25, 25. What do you guys think in the live chat? What do you think the best buy-in method is out of those 3 buy-in methods? I'll give you all a chance to answer. I know there's a little delay in the class. So out of those 5, you got the 25, 25, 50. You got the 10, 10, 10, 15, 15, 40. We got the 5, 10, 15, 20, 25, 25. What is the best buy-in method out of those 3? So Hainsworth and Pookie each said, so Hainsworth said 10, 20, 10, 20, 20, 50. Pookie said 5, 10, 15, 20, 25, 25. But Brad81, Playlits, and Stephen Ibanez, and Lauren Bess is totally correct. And Jacob Lau, welcome to the chat. Welcome to the class. So Stephen Ibanez says there isn't one. Lauren Bess says whatever works for you. And Playlist says whatever one works best for you and the stock. And Brad81 says whatever you are comfortable with. And that is 100% true. Like Kev Cave says, whichever one suits your risk and play style. So, for me, it might be 25, 25, 50. For Kev Cave, it might be 10, 10, 10, 15, 15, 40. For Master42, it might be 5, 10, 15, 20, 25, 25. It's really whatever works for you. What works for some people might not work for the other people. We're all different traders. We all have different emotions. We all have different game plans. So that's why we try not to just follow someone. Someone says do this, do that, do that. You're not just going to do exactly what they say. That's how you become a follower as far as a trader goes. You want to become your own trader and trade with your own plan. Next question is, when do you make your buys? And this is talking about the ones before your last buy. And One answer is at prior supports, one is during price dips, and one is during consolidation. The correct answer is all of the above. You want to use all of those different types of buy-in methods for using your initial buys. You can do it at a support level. You could do it during a price dip. You could do it during consolidation. As long as you're getting a good average, that's all that matters. It doesn't matter exactly how you do it. So what is the purpose of the 25-25-50 method? Well, we had a bunch of great answers. We had someone here say they're all great and they're all right, so I'm not going to even pick a best one. We had someone say it reduces the risk to a minimum loss. One person said not to go all in at once in case the stock drops too far. Someone said to minimize risk but not fully investing in a stock up front and to ensure we get the best possible average. To enter a position slowly, exercising caution, watching the movements and making buys at the appropriate times to obtain the best possible average, therefore maximizing gains. And that is 100% correct, everybody. And then I asked what percent is your buy-in method and why, and we got a lot of people giving different answers, and all those answers are correct. Someone said 25-25-50. I like this buying method because I'm looking for larger profits. I also like it, but because it doesn't require near as much time as others, and that's perfectly fine. Someone says, before this class I was doing 100% or random deposits averaging down. I would like to start implementing 25-25-50 into my trade plan. Someone said 10-10-30-25-25. This is something I came up with that I'm going to try, which is perfectly fine. As long as you're not just doing the 100%, then you're good to go. 10, 15, 25, 50. I feel like starting smaller will help me follow the play without triggering a lot of anxiety because of inexperience. And that's the main thing, is we're trying to, we can't read the charts 100% because we're new traders, and that's okay. But what we can do is we can have a plan, and we can accept that we're new traders and accept that we have emotions and accept that we're human. And we can have a plan and we can get the best average possible because of that plan. And part of that plan is a buy-in plan. And everyone's is different. None of us are going to become the best trader ever in 10 days or 20 days or a month or even a year. It's going to take a lot of time. A lot of traders lose money their first year even. You might lose money your first year. But guess what? Maybe 3 years down the line, you'll end up making a lot of money, and you'll look back to this year and you'll be like, wow, I'm glad I didn't give up because now I'm making a lot of money. Now I'm on my yacht, like everyone keeps saying. Everyone wants to be on their yacht day one, and that's not how it works. So those are some great answers, as always. And today, we are going to be going over a traded plan. So first, I'm going to show you, it's kind of a little, like a template that I made. This is not something that you need to do yourself. I'm not saying you do this. This is just something that I made for myself that I'm going to start following, and it's definitely recommended to do something similar as far as the template goes, as far as what you put on the spreadsheets. But I'm not saying follow me to a T, because remember, we're all different. Just because I'm doing something doesn't mean it's going to work for you. Okay, so what are we going to do first? Let's see. So here we have my plan as far as my buy-ins go. So let me go ahead. I need to pull that up because on my screen it's a little bit small. Denard Haydenforth says to learn patience, reduce risk. Lambo soon, says the real Popeye. This is my note-taking plan. 15, 20. Okay, so as you see in the top, you have the ticker. Oh, you know what? I think I also have the format. There it is. All right, so we have the format and we have the filled out version. So the format is up top, and then the filled out version is going to be in the bottom. So on the top is basically the spreadsheet, the template, and then the bottom is what I filled out. So on the top you see I have a ticker, so in blue is where I'll put my ticker, and then I'll put all my buy-in prices. So for me, I was going to be following in this plan, I'd be doing a 10%, 10%, 10%, 20%, 20%, 30% buy-in method using $200 per buy. So as you see, I would put my buy-ins, my 1, 2, 3, 4, 5 buy-ins, as well as my final buy, and only then will I put my stop loss and my take profit amount based off of that buy. Now I'm going to pick a ratio, a win-loss ratio, and for me I would do a 2-to-1. That's a risk-reward ratio. And before we actually go over this, I want to show you the actual game plan because that's a little bit easier to, then you can see what I base it all off of. So let's go over that first actually. So let me go ahead and pull that up as well so I can see it. So as you see, I have my amount of plays. So I'm going to be doing around 5 to 7 plays each. I'm sorry, 5 to 7 plays, and that's going to be each at $200 per play. And that way I can leave around $500 to $100 cash on hand. Now, why do I leave cash on hand? Well, it's because just in case, after I'm done doing my buy-ins, let's just say I'm in 7 plays and Apple says they're doing a forward split. And I'm like, oh wow, I really want to get into Apple. Well, if I was in 100% of my portfolio, I couldn't do that. Well, now I can because I'm not in 100% of my portfolio. I'm only in 5 to 7 plays. I still have $500 to $100 cash on hand, so I can still buy some Apple before their forward split or after their forward split. Yeah, Jacob Loud, this is one I just made today, actually. Well, that one I made yesterday, but the other stuff I made today. So this is a work in progress. I went all cash so that I can implement this trading plan because I don't want to trade randomly. I want to trade based off of a plan. And I want to be able to record my plan and record my trades and see what I did wrong, see what I did right, see what I do best. That way I can become a better trader based off of that plan. And I might lose, I might lose with this plan the first couple days, the first couple weeks, I'm going to learn from it. And I'm going to become a better trader, and I'm going to be a better trader in a month, in 2 months, in 3 months, and that's the plan. That's the goal. So amount of plays, I'm going to do 5 to 7 plays each. That way I have cash on hand in case something crazy pops up, because you never know. Tesla might be doing something wild. You might want to get into Tesla. Tesla's pretty expensive right now. But there might be a penny stock out there that you just can't miss out on, and if you're in with all your money, then you're going to miss out on it. So I want to know my amount of plays. I want to know exactly how much I'm putting into each play. That way I know how to do my buy-in plan. My buy-in plan then is next. So in this case, I'm going to be doing 10, 10, 10, 20, 20, 30, which means 10%, 10%, 10%, 20%, 20%, 30% of $200. I'm going to have my sector plan, and this is optional for alert following. If you're doing your own trading, then definitely have a sector plan. But if you're following alerts, they're kind of doing the sector plan for you by giving you, they're not going to give you all healthcare alerts or at least our alert as well, because they're very aware of that. So at the same time, it's still good to know what you might do. So for me, I'm doing no more than 1 play in financial, energy, and real estate. Now, why is that? Well, I went on finviz.com and I went to the groups tab, and I saw that I saw that the financial, energy, and real estate hasn't been doing so well the past 3 months, the past 6 months, the past year. So I might not want to get into a bunch of those plays because they just haven't been doing very well. History repeats itself. And that being said, I can change that. I'll look back in FinViz maybe a week or 2 weeks from now and make sure that's the same thing. If it changed, then I'll change my sector plan. I also want to do no more than 2 plays in anything else except for technology and consumer cyclical, because those have been doing well. Those 2 have been doing well, so I don't mind getting in more than 2 of those plays. But ideally, you don't want to get into a bunch of the same plays of the same sector. All right, so now we have our Austin to Lee ratio. Now, originally I was going to do 10 plays, but then I decided that I want to have some cash on hand, so I'm doing 5 to 7 plays. So instead of 8 Austin's plays and 2 Lee's plays, maybe now I'll do 5 of Austin's plays and 2 of Lee's plays, or 3 of Austin plays and 1 of Lee's plays. But basically, I want to do an 8-to-2 ratio, which is 80%. And the reason why I'm going heavy on Austin's plays is because I did an evaluation of myself. I did a trading psychology evaluation, which we did last week. And I realized, I'm not very patient. I get frustrated pretty quickly when I'm waiting on 5 plays to just sit there, and I'm just like sitting on my hands and just staring at the screen like, why are my stocks not going up? Why is my stock still not going up? It's been 3 days. It's been 5 days. It's been 2 weeks even. My stocks aren't going up. Oh my gosh. If that's me, or if that's you even, then maybe you want to go heavy on Austin's plays. The reason being, class, and I'll ask the class this one, why am I going heavy on Austin's plays due to my emotional trading emotions, due to my emotional evaluation, as I take a sip of my NutriBullet. Oh, Isaiah did well today. I finally got it out of the bag. Or not today, yesterday. I was so happy. No more Isaiah for What the Duck. So why did I choose to go heavy on Austin's plays and not Lee's? Lauren Best. That was the best answer, Lauren Best, because they're quicker plays. Pookie's Revenge says Austin trades are better for people who aren't patient. Lees take time to develop, and Lees are slower. Matster42 and Durham Dad. 100% correct. The reason why is that Lee picks those plays that are beaten down, meaning that something bad happened to them and they went down way past where they should have. Maybe they were at $4, they should have gone down to $3 based off of the news, but everyone got scared and everyone was trading emotionally, so now it went down to $2. But the stock should be at $3, so it's going to eventually come back to $3, but it's going to take a catalyst. It's going to take some type of news or just something, volume. It's going to take something, and we can't predict when that's going to happen. But Lee knows it's going to happen, and 9 out of 10 times it does happen, but it takes time. Whereas Austin looks at a play and he sees, oh, this has good volume, this has a catalyst coming up, whether it be earnings or something like that, and he's like, yeah, I'm gonna get in this play because I think it's going to start going up pretty soon. Well, those are going to be quicker plays, and if I get really impatient, I want to take a quicker play. So that's why I'm going heavy on Austin's plays. That might not be best for you. For you, maybe you are patient. Maybe getting into 5 or 6 of Austin's plays might be too much for you to handle because you don't have time to look at the charts. To look at the stocks and look at your portfolio all the time. And if you have 5 stocks moving really fast, you might not be able to get in on all of them with your buy-ins, and you might get overwhelmed. You'd rather just have 4 of Lee's plays, trade them nice and slow, while you can actually focus on 1 or 2 quicker plays and get in on them 100% with a good average. Because even if you have 5 quick plays, if you're not able to watch them all, well, then you're going to probably only be in either A, 25% on all of them, or 20 to 50%, or B, you're not going to get the best average because you weren't watching. You're just making quick buys and you weren't doing it the right way. You weren't doing it based off supports and resistances. You were just doing it because, oh, it went down a little bit, I'm going to buy, because you can't keep track. So if you are working 9 to 5, maybe you want to do a little bit of Lee's plays. I also have my risk to reward ratio, which we went over 2 days ago. So for me, it's going to be a 1 risk to 2 reward, meaning I'll have a 10% stop loss and a 20% take profit for my plays, which means that once the stock gets to 10% down, I sell it. If it goes up to 20%, well, then I sell it. That means, let's say I get into 3 plays for the week. If I lose 2 plays and I win 1 play using my risk to reward ratio, I break even because I'm losing 2 at 10% of $200, and I'm winning 1 at 20% of $200, which is the same exact price, so I'm breaking even. The reason I do that is because once it gets to 20%, I can also set a stop loss or a stop limit at 20%, and if it keeps going up, I'll just keep bringing up that stop and I'll get profit maybe at 30% or 40%. But no matter what, I'm selling at 10%. So worst case scenario, I break even if I lose 2 out of 3 plays. Best case scenario, I'm making some profit. Even better case scenario, I win 2 out of 3 plays. Well, now I'm up 40% and only down 10%. So it's a good way to have a plan as far as when you're going to sell and when you're going to buy, and not just because it's not based off of, oh, I want to take profit at 5% or I want to take profit at 10%. Now you know why you're taking profit at 20% or why you're taking profit at 5%. Well, maybe you want to do a 1 to 2 risk to reward ratio, meaning you'll set a stop loss at 20% and you'll take profit at 10%. That means you can get a bunch of quick wins. Boom, 10% win. Boom, 10% win. Boom, 10% win. And then eventually, I got a 20% loss. Sure, you'll have to win more plays, but it's going to be a lot easier for you to win those plays. So you can really base that off of what's best for you. If you find yourself winning a lot of plays, then maybe you want to do a 2 to 1 ratio and just get a bunch of quick wins. If you find yourself losing a bunch, well, then maybe you want to do a 1 to 2. That way you can still lose 2 plays and win 1 and still break even. I also have my emotion/psychology notes. So that means I want to keep track of my personal life events. I want to keep track of my interactions with other people. I want to keep track of my work hours for each day. I want to keep track of my sleep, my nutrition and eating habits for the day, my stress level for the day, my workout schedule, and the cleanliness of my condo. Because that does, if you're living in a pigsty, you're going to start feeling a little crappy about yourself. So, and you might start trading based off of those emotions. I want to keep some trading notes. I want to keep track of my buy-ins. I want to keep track of when I'm selling for a loss. I want to keep track of when I'm selling for profit. I want to keep track of the market, whether it's a red day, a green day, or just a neutral or boring day. And I want to follow the plan, and I want to make sure that I didn't break the plan. I want to keep track of when I do follow the plan and when I do break the plan. And then I want to compare how my emotional and psychology notes compare to the trading notes and see like, oh, well, I wasn't feeling great on Monday, and oh, look at that, I broke my trading rule. Oh, look at that, I didn't do so well. I sold for losses. Or maybe vice versa. It's good to know how A affects B so that you can change A to get a better outcome for B. Master42 says, what about when people change their name in Discord? Yeah, Austin and a bunch of the other moderators and Mins where we were playing around with the names and changing some names around. Those are really funny though. I know, what was it? Like Actual Trash Plays, they changed his name to like Content, like Decent Plays or something like that. It was hilarious though. Yeah, like Playlist says, we must have patience. That's why I'm doing this, is to afford a housekeeper. Sort of kidding, but I was honestly, Kev Cave, I actually do have a housekeeper, and it is the best thing ever. You know what? The $80, $100 that it costs for them to come in every month, and it's just the peace of mind I get from that. It's so worth it. And plus, then I can use that time that I would be taking to clean, to learn about stocks, or to work out, or to do something that betters myself. So, sometimes it takes money to make money, or just to make yourself happier. Anyway, trading notes I just went over. So now I am going to have rules for myself. So I set a bunch of rules. For instance, once I'm down or up 5% on the day, I walk away. The reason why I do that, if I'm down 5% on the day, and I'm talking about of my portfolio, not 5% profit. Like if I take a 5% profit, that's fine. I'm talking about if I'm down 5% of my whole portfolio, which is a pretty decent amount of money, well then, like for me, it'll be around like $75, like that. And that's not great. I don't want to be losing $75 every day. So once I'm down 5% on the day, I'm going to walk away, because I'm going to probably end up trading emotionally. Either A, I'm going to be trading emotionally because I'm upset. I'm like, oh gosh, I lost money, and I'm going to make some dumb decisions. Or B, I'm going to try to make that money back and make dumb plays because I'm just trying to make that money back, not trading based on my plan. The same way, if I'm up 5%, I might get cocky, or I might be like, oh nice, I made 3 great plays, I made 4 great plays, I'm up 5%, I'm doing really well, I'm on a roll, I can't lose, and then I'll make a dumb play because I'm cocky and I think that that I'm I can't lose, and then guess what, I'll end up losing because I'm not going to be trading based off of a plan. I'm just going to be trading based off of emotions. Like have you ever played a video game, like a racing game, and you're up, like you're in first place by a lot? So you start doing, like Mario Kart, you just start doing some dumb stuff, like trying to shoot the green shells or put bananas around, like to make like traps and stuff, and you end up like hitting yourself with them, and then you end up in 3rd place or 4th place. You're like, oh damn, I really should have just done the whole race the way that I was, I should have actually just done the race. Maybe I would have won. Well, you don't want to get cocky. It's like those people who are doing those bike races, and you see them, they before they cross the finish line, they put their hands in the air like, oh yeah, and then they fall on their ass, and the guy passes them, and they look like an idiot. Well, you don't want to look like that idiot, especially with trading, because then you end up losing money, and then you will go from up 5%, now you're back to even, and you're like, oh, I got to make that money back, and then you're back to where you were if you were down 5% and chasing. So that's another way of trying to not trade emotionally, is just knowing when to walk away with wins and losses. Put it all in double black. Okay. If I get less than 6 hours of sleep, I'll just take the day off, because otherwise I'll be trading tired. I'll be trading emotionally. Maybe I'll take a nap and then go back to trading. But if I'm super tired, I'm not going to pull an Isaiah. And you guys all know what that means. If something happens to bring my mood down in real life, well, then I'll walk away. It could be anything. It could be something at work. I could have just had a really bad day at work. I'm not going to go ahead and trade after that. I'll be trading emotionally. Or something happened to the family. I'm not going to go ahead and trade after that because I'll be trading emotionally. Once I'm in 100%, I must set a stop loss and take profit based off of my risk to reward ratio. So once I'm in at 100% of my intended position, no matter what, I'm going to be putting a stop loss and a take profit. Now, at the same time, I'm also going to be setting alerts for when the price goes up. There was one time I lost 50% of my account because I was emotional, says Jake. Yeah, see, that happens, and that's why we don't want to be trading emotionally, because you lose more when you're trading emotionally than you win, and then you get even more emotionally. You can lose, and you lose even more. But the reason why I'm going to set an alert on my Webull app, or you can do it on StockTwist, you can do it, whatever app that you use to set alerts for your price changes. I'm going to do it for when the price is close to my take profit. That way I can watch it, and if it blasts through my take profit, I'll quickly take away my take profit, and then I'll set a stop loss or a stop at my for instance, for me, it's going to be 20% take profit. So that way, let's say the price goes above my 20% take profit. Right before that happens, I'll be watching it. I'll take away the limit sell. If I see it's doing a very strong movement up, I'll take it away, and then I'll put it right back in as a stop, and I'll just keep moving up that stop so I can get better profit. But I'm definitely not going to let it go back down below my 20% take profit. And that's one way of doing it. You can also sell some of your shares at 20% and then let the rest keep going, and then sell the rest at either 20% if it goes back down, or let the rest ride it up. It's really up to you. But it's really based off of how strong that upward trend is. If it's like really pumping, then I'll take away my take profit. Otherwise, I'll leave it there because it might just hit it and then go back down again. So then I also won't make excuses for myself. I'm only going to learn from my mistakes. And the big one, I will not break my plan. I'm only going to tweak it once it's been tested. And I'm not going to know that it doesn't work until I test it a bunch of times. You can try to make 3 trades and you lose in all 3 trades, and you're saying, oh, this plan is crap, and then you throw it away. But guess what? You could have won, for all you know, you could have won your next 17 trades, and you would have been 17 wins and 3 losses, and that's pretty good. So you gotta give it time to play out. And then you want to tweak it once you know for a fact that you tested out and you saw how all your trades played out, and you were able to compare all your notes, and then you can go ahead and tweak it. So there is a difference between having a plan and having aspirations. So having a plan is what this is. This is having a plan. This is my trading plan. Aspirations mean, oh, I'm going to win. I want to make 5% every day, or I want to make 5% every week. I want to make 5% every month. That's the aspiration. That's you hoping. That's not a plan. What does that mean? How's that a plan? That's just saying, oh, I hope that I make 5% every day, or I hope that I make 5% every week. That's not a plan. That's just you saying, oh, I hope that I make it. That's an aspiration. So you got to make sure that just because you say I want to make this much, that's you just wanting to make that much. Having a plan is saying, this is how I'm going to try to make money. So there's a very big difference. And the other thing is, when you are actually trying out the plan, you want to make sure that you realize that you are a new trader, and that it might not work out the first 10 times. You might not make money your first year. If anyone here ever worked in an office, or as like an accountant, or a lawyer, any of those kind of jobs, those big jobs that take a while to advance in, then you'll know how it works. At first, you don't just go right into it and become a lawyer. No, you go to school first. And by going to school, this is this equivalent of learning. Like right now, we're all learning. This is us going to school. It's literally called Penny Boys University. But I do the same thing. I do so much research, because you got to learn first before you start making money. So you go to school, and then guess what? Then you get an internship, which is an unpaid job. It's an unpaid gig. You're just getting experience. That's the equivalent to paper trading. So a lot of people skip that internship. A lot of people here probably didn't do paper trading. They probably went straight to trading with their own money, and that's not how life usually works. I mean, maybe you got lucky, but you probably didn't. A lot of us here probably lost a lot of money before we joined Penny Boys, or even currently, because we don't know what we're doing, and we're trading with our real money. Even though you are on an internship, you should be trading with paper money. And then eventually you get a small job. You get your first job. You're not making so much money, but you're learning. You're learning, and then eventually you get promoted. And then eventually you start making real money. That's how trading works. It's a slow process. No one's going to get rich quick overnight. It's not how it works. If that was the case, everyone would be rich right now. There'd be no hunger. There'd be no, there'd be no poverty. We'd all just, if stock market was easy, everyone would be making money right now. We'd all have money. But it's not easy. It takes time, and it takes learning, it takes patience, and it takes a plan. So make sure that you understand that having aspirations is different than a plan. Just trying to hope that you make money is different than actually making money. And in the same way, your plan might not work the same way as someone else's plan. If you watch someone's YouTube video, even my YouTube video, and you see this plan, you can't just copy this plan. It's not the same plan. I'm not the same person as you are. You can try, and maybe it'll work for you. Maybe we're very similar. But guess what? Maybe we're not. Maybe what works for me doesn't work for you. Someone playing, second base in a baseball game, they're not going to use the same glove as a first baseman or a catcher. This is not going to work for them. They're a second baseman, not a first baseman, not a catcher. They're all in the same field, but they're using different gloves and they have different plans. Same thing with baseball bats. Just because Barry Bonds uses a whatever weight baseball bat doesn't mean that someone smaller, like Jose Reyes or whatever, can use the same bat. He wouldn't do very well. Everyone uses a different plan. And as far as getting into a play goes, and these are just some quick tips and tricks before we get into the next part. As far as getting into a trade goes, when you look at a trade, when you look at an alert, you don't want to look for a reason why you want to get into the alert. What you want to do is look for a reason not to get into the alert. And you might want to set some different reason. You might want to say, all right, I'm not going to get into, like I said, I'm only going to get into 80% of Austin's alerts. Maybe you don't want to get into certain sectors. Maybe you don't like shippers because they do reverse splits, if anyone knows what I'm talking about. Maybe you don't like the beaten down plays. Maybe there can be like 5 or 6 different references or different things that you just don't like. And if those plays that you're looking into fits that mold, then don't take it. You rather look for plays that you don't want to get into. And then if you can't find a reason not to get into it, only then should you get into it. It's like when you are going mountain biking. And I'm not talking about a actual mountain bike path. I'm talking about like off-roading. Like if you're going off-roading on a trail, you're not just going to go down any random trail or just go into the woods and just start biking. What you're going to do is you're going to look first and you're going to say, why shouldn't I go down that? Maybe there's a rock, maybe there's a tree, maybe there's there's the cliff. You're not going to look for reasons to go down it. You're saying, why shouldn't I do this? That's how you get rid of risk. You want to make sure it's the right trade for you. You want to make sure it's the right path for you. If you ask what the target is for a trade, if you are already in a trade or an alert, and you're asking what the target is, you shouldn't be in that alert. I'm sorry, that might sound harsh, but you should not be in a trade if you don't know what the target is. Because that means you're not trading based off a plan. That means you're just following the leader. And why would you follow the leader? How does that make you a better trader? Sure, use the alerts as, hey, this is a good play. At least I know it might go to this target. At least I'm going to use that target as a resistance at the very least. But my target might be different than the alert's target. My average might be different than the alerter's average. My portfolio is probably going to be different than the alerter's portfolio, and my trading plan is going to be different than the alerter's trading plan. Just because the alerter says something doesn't mean that you have to do the same exact thing. Have your own target. But if you're asking what's the target for this, then you shouldn't be in the play. You should already have your own target. Otherwise, you're just gambling. Otherwise, you're a gambler. You're just taking a risk. You're just saying, hey, maybe I'm gonna jump in this play and see what happens, but I don't know why I'm doing it. I don't know what I'm doing. I don't know how I'm doing it. You got to know why you're getting into a play. You want to know what you're getting into, and you want to know what your goal is. And at the same time, if you ask, should I cut my losses? I'm down this much on this play. Should I cut my losses? Well, guess what? You also shouldn't be in that play because that means you didn't follow your plan because you didn't have a stop loss. You didn't know this is the amount that I'm willing to risk on this play because clearly, if you're asking, should I cut my losses? Well, that means that you don't know what your stop loss is, or you just never set one. So don't be asking, should I cut my losses? Unless it's a play that maybe you got into before you had a plan, and that's fine. If you're currently a bag holder from before, and you can admit, hey, I was stupid before, I didn't know what I was doing, I have these bags, what should I do? Do you think it might come back? That's one thing. But if you're in a current alert, and you already have a plan, you're saying, should I cut my losses? Well, no, you don't. I don't know. I'm not going to tell you. What does your plan say? What's your stop loss? What's your average? Like, what's it based off of your average? What is your plan? This might be different than someone else's. So you got to know what you're doing and what you're getting into before you get into it. Otherwise, you're just going around blindly and you're gambling. And gamblers don't belong in the stock market. That's why we get a bad rep. That's why people think that day trading and penny stocks are such a dangerous game. It's because people don't know what they're doing. And it is dangerous if you don't know what you're doing. Biking is dangerous if you don't know what you're doing. There's a lot of things that are dangerous if you don't know what you're doing. The other thing is, a lot of people take these plays and they're, let's say you're up 20% and you're like, oh, I really need that 40%. I'm really trying to make money in the stock market. I really need to pay my bills or this or that. Well, guess what? That stock does not give a duck that you have to pay your bills. That stock does not care that you have a family. That stock does not care that you have child support or that you have loans to pay, student loans. It does not care. It doesn't care. All it cares about is, it doesn't care about anything. That's the thing. The stock doesn't care about anything. It's going to go up, it's going to go down, regardless of what your financial situation is. Trade your plan. Think of it like a job. If you are in a job and you're like, oh, I really gotta make those bills. Can I? You're not gonna ask your boss for like a $20 raise because I gotta make the bill. You're either gonna get a new job, which means get a new trading plan, or you're just gonna keep trading. You're gonna keep doing that job and just hope that you can eventually get a raise. Which in this case is just keep trading, keep getting better, and maybe eventually, these stocks can pay your bills for you. But it's not gonna happen overnight. You don't get a job promotion overnight. And also you want to track your trades. You want to see what you get into, why you get into it, and then you want to say, after you're done getting into it, you want to track them. There's a reason why people in baseball, they look at batting averages, they look at home runs based off of strikeouts, they look at all that stuff because it matters. You can see, oh, this guy's a power hitter, this guy's not, and they wouldn't be able to do that. They just watched him play a bunch of times. If you watch someone play without actually without actually keeping track of all the statistics, you can maybe guess if they're a good player, but you won't know for sure. And the last thing, and just based off of that, you want to track everything because let's look at your bank account versus how much you make, your income versus your bank account. Imagine trying to live, you get your paycheck, but you don't know how much it is, and then you have a bank account, but you never actually look at it. You just hope that I hope that it's positive. I hope my bank account's looking good. That's not how it works. You keep track of your bills, you keep track of your income, and you try to make it match. And last thing, a lot of people think that they're good at trading. A lot of people think that they mastered trading. A lot of people think that just because they got the moving averages down and they got the VWAP down and they figured out how candles work, that they know everything there is to know about trading. Well, guess what? You probably, you might be a good driver right now. You might know everything there is to know about your car and driving your car. Well, guess what? Get behind the car of a different car. Get behind the car of a stick shift. Get behind the car of a racing car. $20 says you're not going to be as good at driving that car as you are at driving your car because it's more advanced. There's always more to learn. And people who think that they are the best at something usually aren't, and they're never going to be if they have that mentality. So always keep learning. Okay, done with that little TED Talk, I guess. So let's go ahead, and so this is my plan. Now, what do I do with that plan? Well, I'm going to bring up that little chart that I had before. So this is my buy-in. This is how I'm going to keep track of that plan. So let me just pull it up on my screen so that I can see it. Okay. So I have the ticker. So on top is the blank version, and this is, I'm not saying make exactly this. You can. There are a lot of people who have much more complicated spreadsheets. I'm not very good at Excel. I don't know how to do all those, have A follow B and minus this and that and divided by whatever. There's a lot of people who can do much better spreadsheets than this. I think we actually are working on a Penny Boys spreadsheet that we're going to be either giving out or selling, depending on, or just giving out with Penny Boys reward points. I'm not 100% sure exactly how it's going to work, but for now you can make your own. I just made this. This is a pretty simple one. There's no calculations involved. I just wrote down a bunch of stuff using letters. No numbers, no pluses and minuses, and any of that kind of stuff. Did Austin Lee have a watch list? How do they know what stocks to go into? Every night they look at FinBiz, or they look at, no, they have their own scanners. They have way more complicated scanners than FinBiz, but they do scans. They stay up. Austin stays up till freaking like 5 a.m. sometimes. He stays up to pre-market sometimes, and he scans stocks, and he figures out these are ones I'm going to get into, and these are ones I'm not going to get into, and he uses a plan based off of that. And we're actually, next week, we're going to be going over candles and stuff like that, because our goal is to eventually become our own traders. So we can figure out what candle patterns that we trade the best, and then we can scan for those candle patterns, and then we can play those candle patterns the next day. Austin Lee usually looks up stocks that are near their 52-week low. He'll look at stocks that, they might have at least this amount of volume. Austin might look at stocks that have good volatility. It really depends on what works best for them, and it took them a long time to figure out what stocks they trade the best. But that's how they find their stocks, and they probably do have a watch list. So I have my ticker up top in the top left, and I probably do this for every single stock actually that I get into. So I have like 5 blank versions of this, or 5 to 7. And so I have my ticker. I'll have my buy-in price. I'll have my date that I got into it. I'll have the reason I got into it, and the emotion that I was feeling when I got into it, as well as some just notes, just some miscellaneous notes. And then I'll have my buy-in 1, my buy-in 2, my buy-in 3, and these are the prices that I bought in at. So, and then underneath that, I'll say who the alerter was, when the alerter entered it. That doesn't mean that that's when I'm going to enter it. But it's good to know because you are following the alert. It's good to know when they got into it and what their targets are. But that's not going to be my target, and that's not going to be my entry. My target's going to be based off of my 2-to-1 ratio. It's going to be based off my 20% profit sell and my 10% stop loss. I don't care what their target is. But that being said, I'm not going to get into a play that their target, because their targets are resistance points. If my percentage that I need is 20%, and their resistance point, their target is only 15% from the entry, I'm not going to get into that play because I can't get to my goal. I can't get to my target. Do I usually trade per day? 1, 2. Really depends on my plan. It depends on what's going on in my plan. If it's all working out, everything's going well, then I can do 4. I'll do 5. I'm not going to get into more than 5 plays per day. But if the only reason I use the targets is if that target 1 and target 2, if those targets that they think that it can reach isn't 15% from the entry, or isn't 20%, I'm sorry, from the entry, then guess what? That play is not for me, because my plan is to take profit at 20%. So if their target, it says, I don't think this stock's going to get to 20% profit, well then why am I going to take it? That's right in the beginning. I know that I can't follow my plan based off of that trade. So that's how I use the targets. I use them as resistance points, and I use it to see whether or not I want to get into the play. I'm not going to just follow it blindly, but I use them as resistance points. And I also want to know who alerted it, because like I said, I want to get heavy in Austin's plays, because Austin's plays seem to work out a little bit more as far as the short term goes. And they're a little less risky, a little less GLBS action going on, some of those beaten down plays just keep getting beaten down, and they are a little bit more risky sometimes. I want to know why I entered it, and just some miscellaneous notes. So for instance, I got into this ticker. Let's just say this is totally not a real ticker. It's PBU, Penny Boys University. Not a real ticker, not a real play, but this is all based off just like, I just made all this up. But this is what I would do in an actual trade. So I'd write down my buy-ins. So my 10%, 10%, 10%, 20%, 20%, and 30%, which is $20, $20, $20, $40, $40, and $60, because my plan is to get in $200 into a play. So these are my buy-in prices. I bought in at 1, then 96, then 90, then 85, 81, and then my last buy was at 86. I saw some confirmation. I bought in at 86. I wrote the date that I got into it, so that way I know how long the play took, and I can see, looking back on the play, did I get in too quickly, or did I wait? My reason, whether the RSI was oversold, it was a dip buy. It was a prior support was 90 cents for the week, so I set my buy at 96 cents. The sector wasn't doing well, so it was another dip buy. Or a VWAP bounce, or volume increased and it broke the SMA 50, so I did my last buy. I want to write down my emotion next to that. Maybe I was feeling tired and restless. I was losing on the day. And I'll have a trading note next to that as well. So on this trading note, I'm going to say I should have waited on this one. I wasn't feeling great. And these are post-trade notes. So once I'm done trading, I'll write this down. Either for the day or for the week, I'll write these down. Because I still want to remember what is going on. So I'm not going to wait until the whole trade is over. I'll write down, here I was tired, I was restless, losing the day again. So I didn't do enough due diligence on past trading patterns of the stock. I was just trading because I was emotional. I was feeling great, so I had a great buy. I was patient. I did my due diligence on the charts and based that off of my buy-in. I had a great workout. I was feeling good. I was in a great positive mindset. I was happy with this buy. I looked on the groups tab on FinViz, and that's why I saw that the sector wasn't doing well, so I had a good dip buy. And that's the reason why I did that, is because I knew, in this case, the sector wasn't doing well, so it's not just the stock wasn't doing well, it's just following the sector. I was losing the day. I was trying to be patient. And my trading notes is that I had a VWAP buy, and it seems to be working for me. So now I know, oh, maybe VWAP's something that I can trade pretty well. Maybe VWAP's something I might want to look at more often. And the next one, I slept great. And the Weeble comments were lit on this one. So now I'm like, maybe I should look at the Weeble comments, not to use them only, but it's not the worst thing to see what people are talking about. And of course I would look at other stuff as well. And then of course I would write down after that my stop loss. So after I get in 100%, I'm setting my stop loss. So for in this case, it's 78 cents, which is going to be 10% from my original, or from my 100% buy. So my 100% buy was at 86 cents. That was going to be on 714. So 10% from that would be 78 cents. So my average there was around, I want to say it was like 80, it would have been 86. If anyone's really good at math, they should know. But I think it was around 86 cents, or 84 cents would have been my average. So look at that. I bought in at $1. That's when we first alerted it. Even though I had my last buy was technically averaging up. But my average is now still 85 cents, 84 cents. Not $1, it's 84 cents. So this way I can set my stop loss at 78 cents instead of at 90 cents. I would have been stopped out. If I had bought in all at once at $1 and I set my 10% stop loss, I would have already been stopped out. But because I didn't do that, because I averaged down, because I did the buy-in rule and was able to get the perfect average, not average down, because I wasn't in 100% at the time, but because I got the perfect buy-in, now I'm able to put my stop loss at 78 cents, and my 20% take profits now at $1.04. Look at the target. The target's 115, 125, 140. So I'm already going to be making money if it just goes right back to alerted entry. If it goes to target, then I'm even better off. So using this small but steady buy-in method, slow and steady, I'm getting the best average possible. I'm following my plan. I'm not trading emotionally. I now have a stop loss that is at a perfect price, a great price. 78 cents is probably not going to go down that hard. And my profit off of my risk to reward ratio is $1.04. And guess what? Look at my trading notes. I didn't hit my stop loss, and I set a stop loss. I set a stop at 104, and I moved it up as it rose, and I sold at 120. I made $60. I made 40% off of that trade at 120, which is right below that target too. So what that means is once it hit 104, I had an alert. Let's say it went up. It started running. It's at $1.02 or $1. My Weeble, it beeped. It went off. It said, "Hey, it's at $1." So now I'm looking like, oh, it's really pushing. I take away my limit sell. It goes past that 104. I set a stop at 104. It keeps going. Now it's at 110. All right, I'm gonna set my stop at 107. Let's just say. Now it's at 115. I'm setting my stop at 112. Now, wow, it went up to 120. I'll set my stop at 115, 118, and then it went up to 124, 125. I set my stop at 120, and it hit my stop. I sold at 120. I made $60. I made 40% on that trade at target 2, right below target 2, and that's because I made a slow but steady buy-in. So, and I did it based off of reasoning and based off of using my emotions. And now I can look back at the trade and I can say, what did I do right? And what did I do wrong? And then I can, once I have like 20 of these trades or 50 of these trades in my book, I can really start seeing like, all right, the VWAP seemed to work for me 20 times out of 50 times, or 30 times out of 50 times, or these sector play, these sector buys seem to work for me 40 times, and or maybe the moving average didn't work for me 40 times, so maybe I'm not going to use that as often. You can see what works for you and what works best for you. All right, and then miscellaneous notes, playing this one slow. The reason I entered. Oh yeah, and you also want to know the reason that you entered. And the reason that I entered here was the earnings are coming up, and Austin seemed very confident about this one. And my miscellaneous notes are I'm playing this one slow. Okay, so let's go ahead and go to this. And this is so small too. Let's see. This is me seeing this is my trading notes versus my emotional notes. So now I will see for each day. I'll show my buys, my sells for profit, my sells for losses, my market, how the market was doing, and if I follow my plan. And emotions, my personal life events, interactions with others, work hours, sleep. Remember that plan that I showed you before? This one right here. There it is right there. So you see how the emotional notes, keeping track of personal life events, interactions with others, work hours for each day, that's exactly what I'm basing whether or not I follow this plan off of. So it's the same exact thing. So I have my plan, and now I'm writing down whether or not I follow this plan. Do you do these different tabs in a single Excel sheet? Yeah, I mean, honestly, there are probably better ways of formatting the Excel sheet. I literally just did this today. I'm not a huge Excel or Google Sheets person, but it's the stuff that's in there is what's important. But honestly, if this formatting doesn't work for you, you can format it whatever way you want, and you can put whatever you want. It doesn't have to be exactly the same because maybe some of your emotions are different than mine, and so it's really based off of you. Let me just read some of these. So, Jacob Lau, master playlist. I can copy and paste my emotions for days. And that happens sometimes, and you know what? And that maybe for the week you want to write down how your emotions were, and base it off of that. Master says, I've been using FinViz and TOS scanners and been tweaking them since I started here. I actually have found some that were alerted same day, so that's awesome. That's awesome, Master. Yeah. I always, whenever I find a stock on FinViz that just got alerted, I'm like, heck yeah, I'm doing it right. And that's why we use these alerts, because Austin and Lee are so good at what they're doing. Fast Eddie, he knows what he's talking about. It's good to use them, but you don't want to follow them to a T. You want to use their knowledge and learn how to become your own trader, but still have them in your back pocket as far as like a tool goes, as a way of seeing if you're doing it right or if you're doing it wrong. And a way of just calming your own emotions, because it's always good to go back onto them. I've just been paper trading those so I can see how good my scanner's analysis of the chart is. That's awesome. That's exactly what you should be doing. Honestly, you can use the alerts for now and paper trade some of your own plays. And once we get into the candles, you'll learn how to actually scan for your own plays based off of candles. And honestly, maybe you'll only do 2 different candle patterns. You'll only trade those 2 candle patterns, and you'll see which ones are really good. And that's how you become really profitable. You become a master at certain trades, as opposed to just being decent at like 10 different plays and being all over the place. Are you able to day trade? I realize it's kind of difficult to trade if I can't day trade. So for me personally, the way that I day trade, now that I'm out of my Isaiah bag, is that I use a cash account. So let's say I want to day trade $200 a day. I'll put $600 into that cash account. So because the cash account on Webull, it takes 2 days to sell your funds. So I'll trade $200 Monday, $200 Wednesday. I'm sorry, $200 Monday. I can't even have the days work. $200 Monday, $200 Tuesday, and then by Wednesday, my $200 from Monday are settled. I'll just do the $200 again. So it's just cycling those $200 out. And if you end up losing, then you can't do that. But if you end up losing, then maybe you should just go back to paper trading for a little bit until you find a good way of day trading. I typically just swing trade. I work from home. There you go. So what's the point of paying for premium if you can't trust those alerts and you need to do your own due diligence, scanners and all that, because they know what they're talking about. The alerts are a good guide, but if you're following them blindly, just like anything, if you're in a job and they say, hey, these are the 10 things you need to do, but they like for instance, like in a restaurant, some bartenders bartend differently than others. Just because they're a great bartender doesn't mean that you're gonna watch them and do exactly what they do. You're going to have your own little system, but you're going to learn the basics from them. You're going to learn, and you're going to use them as a guide. You're going to say, hey, how do I make this really quick? And it's good to use them as guides. And also, in theory, the alerts are you could in theory follow them to a T and you'll be fine, but it's much easier and it's much better if you do it based off of your own plan. Otherwise, because they are in a lot of alerts, it's hard for them to be able to update every single one and hold your hand the whole way through. You want to be able to not have to have your hand held the whole time, because that's not their job. Their job isn't to hold your hand. Their job is to alert you of, hey, this is a good play. This play is going to go up. I don't know when it's going to go up because I can't tell the future, but it's going to go up. So you want to use them as guides, but you don't want to blindly follow the leader. And also you want to get your best average possible. Updating your stops is way easier on Webull than Robinhood. I think Webull is in general is better than Robinhood, honestly. Jacob, wow. And if you want to do due diligence after the alert, then it's most likely too late to get in. If you want to do due diligence after the alert, well, if the alert's already alerted, you can still do your due diligence. And you can see, all right, this is why you can do quick due diligence. We have a course on how to do quick due diligence in order to get into alert. Actually, it's in the YouTube channel. Yeah, you want to be able. You don't want to be doing. This isn't like you're getting into your own trades. You don't want to do hours of due diligence with these alerts. You want to just quickly see, all right, this is a play that I want to get into based off of A, B, C, D, E. Is this Austin's release play? Is this in the right sector for me? Is this? Are in too many plays? And there's other things that are on your own trading plan. Let's see. Yeah, I think the Webull is better than Robinhood, just personally. There was one trade which I was up about $500, but I couldn't exit because I don't have a day trade. Yeah, and honestly, I would save your day trades for swing plays. I know it says day trades, but I would save them for when you're in a trade, you're up $500, and need to sell it that same day, because some of these trades will pop the same day. Because even though they think it might take a couple days, they might get news. They might have gotten bought out by Apple or something like that. So you want to be able to save those day trades. So do these as different tabs in a single? Oh no, so yeah, I do them as different tabs in a different Excel sheet. Yeah. And Poogie is right, because you're still giving great alerts, and they've done their own due diligence on those stocks. We just encourage you to do your own as well, to be responsible for your own trades. Yeah, these are great trades. They do hours of due diligence. They know that this is a good stock. It's a solid company. Or they have earnings. They find stuff that we can't find. We can do hours of scanning. We won't find these stocks. We won't be finding them the same time as they do. These are great alerts. You want to be able to know why you're getting into it, and you want to know what your target is and why it's your target. Because otherwise, if you're asking what's the target, then you don't have a plan, and you shouldn't be in the trade. In the end, it comes down to breakdown, and I have to wait till tomorrow to close and hope that it doesn't fail. Yeah, and that's the problem, Jacob, is that you end up just hoping that tomorrow comes and it'll still be at the same price that it was. That's why we save our day trades for these swing alerts, just in case they pop up or in case we had to stop out. Because if you use your day trades, all 3 day trades, and you have a swing play and you had to stop out that same day, now you can't. And the alerts typically dip after they're alerted, so there's definitely time to get in, which is definitely true. Alright, so here I have on the screen is my emotional notes as well as my trading notes for each day. So I have 701, 702. So my buys, for instance, I got into XYZ and ABC today. Did I sell anything for profit? No. Did I sell anything for a loss? No. How was the market? It was red. I followed the trading plan? Yes. Personal life events? None. Interaction with others was positive. Everything was pretty good on that day emotionally. I followed my emotional plan? Yes. For day 2, though, I made 3 buys in XYZ, didn't sell anything for profit, but I sold ABC for a loss, minus $15. But I wasn't in 100%. The market was red. Did I follow my trading plan? No. I sold ABC even though I didn't have a stop loss and I wasn't in 100%. So I probably got emotional or scared, or I used fear. Whatever it was, I didn't go by my trading plan. Now I can look at my emotional notes and say, I wonder if that has anything to do with it. Well, interactions with others was negative. I had annoying customers today, so maybe I wasn't feeling the best. I had 8 hours of sleep. I'm sorry, I had 5 hours of sleep. Worked for 8 hours, so maybe I was tired. I waited to eat, so I was hungry during the morning. So maybe I was a little bit hungry, so I wasn't thinking straight. My stress level was a 3. Didn't get a workout in. The condo was dirty. Clutter was around the condo. Did I follow my emotional plan? No. I traded tired, and I let my interactions affect my trading emotions today. So hey, didn't follow my emotional plan, didn't follow my trading plan, and I lost money. I wonder why. So I can now look back at that, and see how to tweak that. Day 3, I did follow my trading plan. I bought in 100% XYZ. I bought PBU. I bought LMNOP. I sold nothing for profit, sold nothing for loss. The market was neutral. Did I follow my emotional plan? Yes. I made a few buys early in the day, but I got stressed out at work, so I set a few limit orders, stopped trading, and I walked away. So maybe the reason I didn't have any losses was because I realized, I'm not feeling great. My emotions aren't in the right place. So I walked away. And even though I didn't make money, I didn't lose money. And I probably would have ended up losing money if I was trading emotionally. So that's another way of following your emotional plan. Day 4, I bought nothing, sold nothing for profit. I sold XYZ for I'm sorry, I did sell XYZ. It's under the wrong tab. I sold XYZ for a huge gain. I'm up 7% on the day in my portfolio, which is big, because that's 7% of the. In this case, it would be $1,500, which is nice. That's like around like 80 bucks or so, 90 bucks. So the market was green. Did I follow my trading plan? Yes, I set a limit and I sold for profit. It was my emotionals. Did I follow my emotional plan? Yes, I made over 5% of my total portfolio, and I walked away after. I didn't want to let that trading high get the best of me, like we went over before. Even if you're losing money and you lose a certain amount, for me it's 5% of my total portfolio, I'll walk away. At the same time, if I'm winning money and I get up to 5% of my total portfolio, I'm not going to put it back in the market. I'm going to walk away, because otherwise I'll get that trading high, I'll be cocky, and I'll probably end up losing money. So that's how that works. So if you want to be a part of our Penny Boys community and get some of these alerts, here's one of the alert breakdowns. And if you sold this one or based this one off of your plan, you could have made some good money. If you didn't and you traded emotionally, you might have ended up losing. But you can join us at discord.gg/btpenny or facebook.com/group/btpenny. I'm just going to leave the chat open for some questions or just some comments. I'll be going over some stuff. I'm just going to read the chat really quick. So we got Brizzy Frey. What's going on, Brizzy Frey? If you're continuously doing your own due diligence, you'll see some alerts from the group that come up that you may already have been studying. And also, you want to the main thing about this whole trading plan thing is that you want to know what works for you and what doesn't work for you. Even if you are doing the right buy-ins, but you're not tracking them, then you don't know, you don't know why you are making money. You just know that you're making money. And then maybe you'll end up not making money the next month. You'll be like, why is that happening? It's because you didn't know how to make money. You didn't know why you made the money, and then you can't follow that exact plan. If you know why you're winning, you know what you're doing right, then you can know to do it again. If you know what you're doing wrong, you can know what not to do again. But yeah, these alerts are definitely great alerts. What we're stressing is that you don't want to be following alerts your whole life. You want to be following the guide, the people who are alerting them. You want to be using Austin and Lee as learning tools, but you don't want to just be following a leader every time. That might work for pump and dump scams, and it might only work for you 4 to 5 times, or 4 out of 10 times, because you got in on the pump and you didn't get dumped on. But these aren't pump and dump scams, so you want to be able to trade based off of your own plan. But these alerts are definitely accurate, but if you have your own plan, then you can trade even better. You can become your own trader. Let's see. I bought WHLM instead of KOD. Oh, geez. Yeah, it happens. And if you have a note-taking system, then you'll be able to see, why did I get into WHLM? Why, what did KODK? What did I miss in that? Like, how did I miss that one? What was it that why didn't I get into it? Why did I get into the other one? Was it based off emotions? Was it based off of a certain trading pattern? Was it based off of moving average? You can say, all right, well, maybe like 9 out of 10 times this pattern works. It seems to go up. Maybe I'll start getting to those kind of plays. If I'm going to do an Austin day trade play, do I still follow 25, 25, 50 buy-in? So for day trades, it's different. These are for swing plays. For day trades, you might go in 50% and 50%. You might even go 100% because they are quick trades. And they are for advanced traders. You can lose very quickly with day trades if you don't know how to follow the charts. But you typically are not going to be buying in slow for a day trade. They are quicker trades in general. So I would not recommend a 25, 25, 50 for a day trade because they are quicker. You want to be able to, you might want to get in 100% or just do 50-50 for those. Yeah, KevCave is 100% right. If they were oracles, they wouldn't even be charging anything. They wouldn't be here. They would be on their yachts and their boats. No one here can. No, there's no one. Anyone who tells you that they can get win 100% of their trades, they're lying to you, and they're just trying to take your money for 1 month or for a year, whatever their charge is, and then they want to just take it, and then you'll end up losing for that month, and then they'll say, well, we'll get someone else next. It's not how it works here. We actually want you to become a better trader and to learn. And the only way to do that is by seeing what you did wrong and what you did right and having a plan. And Austin and Lee, they are so good at what they do, and it's so, like they do their live trading streams now. I believe it's going to be Wednesdays. This is going to be so helpful. We have Sundays. We have John Tagman, who has many, many years experience going over some stuff as well. So the more you learn, the better you can be. But yeah, this is all based off of just trying to figure out what you can do better as a trader. And if you follow your own plan, you can follow the alerts even better than if you were just blindly following them, because sometimes stocks go up, sometimes stocks go down, and it's good to know what you're doing. I'm just reading the chat really quick. Yeah, if you ask me how to, I'm going to charge you $120 an hour, much less than yeah. And the reason why we're doing this is because they are only charging $75 a month for all this stuff. If you wanted to get your hand held the whole time, and you wanted perfect alerts, then you'd be paying a lot more than $75 a month. You can pay less than that for a lot, for alert people who are just going to say, hey, this is a stock that looks like it's moving. This is a stock that is on the Webull top 5 list, and they're not going to tell you anything about it, and they won't be there for you, and they won't be helping you throughout the trade, or just in general. KevCave, yeah, definitely check out the quick due diligence lesson. It's definitely worth checking out. Margin accounts are just, margin accounts are, so we have cash account, we have margin account. Margin account is just like your normal account, like that you would have on Robinhood, basically. Whereas Webull, you have the margin account and the cash account. And Webull, Jacob Lau does accept both margin and Webull accounts. And yeah, you need to have different emails, like KevCave said, in order to do a Webull cash and margin account. But yeah, I definitely recommend Webull over Robinhood, just for the trading hours alone, honestly. Yeah, and off of what Mike Z is saying, like actually what Pookie's saying, everyone is different, and everyone has their own reasons for joining. Some people see, oh, alerts are really good. Alerts have a great percentage. I want to get in. I'm gonna get in because I want to make 100% every trade, but that's not how trading works. We also give out education because education is how you become a better trader. We're not just pumping and dumping these stocks. We actually care about you as people and as traders. Take care, Madster. And yeah, I think it's a 36% success rate per alert. So it's definitely, the stats are there. I think it's probably went up since then, actually. Why wouldn't we want a margin account? It sounds better to me because you get money from stock sales instantly. Yeah, I mean, the only reason to do a cash account is for day trading, honestly. Or if you want to have unlimited day trades, like in case you want to get into a bunch of risky plays and you might want to stop out every so often. So I have to open a cash account using a different email with Webull if I want a margin account too. Correct. Yeah, that's how the cash accounts and the margin accounts work. All right, we're going to continue answering questions in the new member program chat. It's actually now called the PBU chat, Penny Boys University chat. We're going to have some changes going on to what used to be new members program, so definitely keep track of that. There are going to be some great changes. And if you're not already in the Penny Boys University, it's free with a premium membership. And you can find that at facebook.com/groups/btpenny or at discord.gg/btpenny. So definitely find us there and meet us there and join me so that you can make some bread.